Hi, today we are going to talk about the recent development in the financial markets where we have seen the yield curve for Government of India bonds actually shifting up significantly with the long end rising by almost like 50 to 60 basis point and the 10-year bond yield has actually increased from something like 640 to 7%. This has been in response to the fact that RBI refrained from announcing a rate cut on 8th of February, its last monetary policy announcement. And it also very significantly announced that it has moved from an accommodative policy stance to a neutral stance. What it means is that RBI will not be aggressively purchasing Gsec through OMOs as it did over the last 8 months, which implies that this whole artificial suppression in yields that had happened over the past 8 to 9 months would go away, and as a result of it, it would unwind. So I think that's a very important read-through for the financial markets, including bond markets and stock markets. The three reasons I would say that went behind this decision, the fact that there is a response on the yield curve, are that number one, the RBI believes now that there is a upside risk to inflation. And as a result of increase in commodity prices and stronger dollar, it is likely that the domestic inflation would go up. Number two thing is that there are clearer signs now that global yields would go up, with Fed giving a clearer signal that it would increase rates going forward, and that should transmit into a sort of a hardening bias for domestic yields as well. Number three thing is that, as I said earlier, absence of OMO support from the RBI on the yield curve would also translate into sort of steepening in the yield curve. So we believe that there are clearer signs for the Gsec yields to rise going forward further, and hence we believe that the 10-year bond yields would actually go up to almost like 750 to 780% in the next 9 to 12 months time. This is an important development for the stock markets in particular. There are three implications that we are looking at. Number one, we believe that a steepening in the yield curve would be sort of adverse for the PSU banks in terms of the stock performance and also fundamental performance, because over the last 9 months or so, flattening in the yield curve thanks to the easing of rates by RBI and OMO purchases had translated into significant trading profits for the PSU banks. Excluding the huge trading profits that PSU banks had made on the Gsec book, their performance has been very adverse, and excluding that trading profit, they would have actually made losses. So hence, if we factor in the reversal in the yield curve, it is likely that in the following quarters their profitability will be impacted very significantly. That's number one. Number two, we believe that as the credit growth recovers from the impact of demonetization, it is likely that private sector banks who are adequately capitalized and are well positioned to grow, they will be able to increase market share significantly. Number three thing that we are saying is that with a hardening in the Gsec yield curve, it is likely that the beneficial impact of lower yields earlier on for the NBFC sector could actually diminish, and as a result of that, we will need to be fairly selective on NBFCs that we would like to buy. So thank you.